Hello, good afternoon. My name is Mitch Ackles. I'm the president of the Hedge Fund Association. I want to thank all of you for joining us today for the HFA webinar, Venture Debt, What Investors Should Know. Before we kick off, I'm going to give you a brief snippet about the HFA, for those of you that are unfamiliar. We're a global nonprofit, volunteer-driven organization founded in 1996. In fact, this is going to be our 25th anniversary this year. Our members include hedge funds, private equity, venture capital, real estate funds, wealth management firms, institutional investors, and other industry participants. We organize frequent events like this one. Normal times, those are physical events. There's symposiums, breakfast briefings, conferences, golf outings, cocktail receptions. But today, we're glad to have you aboard for this webinar. And I also wanted to thank our sponsor for today, DLA Piper, for making this event possible. Some information about DLA Piper will be circulated to you after the event. They're a global law firm with lawyers in more than 40 countries. And I'm not going to belabor all of the details of this slide, but just rest assured that we will be in touch with you with these details, as well as our sponsor can follow up with you directly. And now, since I don't want to eat up too much time, I want to introduce our panelists and our moderator, and then I'm going to turn it over. So today we've got Laura Johnson, a director with Oryx Growth Capital, William Kidston, senior investment analyst with Emerging Technology Fund, Katie Sobel, a managing director of Credit Solutions with Silicon Valley Bank, Zach Ellison, Managing General Partner of Applied Real Intelligence and the Fund Association's West Coast Regional Chapter Director. And our sponsor and moderator today is Matt Schwartz, Head of Venture and Growth Lending with DLA Piper. So Matt, why don't you take it away?
Thank you. It's great to be here today. We have an awesome panel, a really great cross-cut of the market, and I'm excited to dive in. We're going to give you 3 rounds on venture debt today. We're going to talk about some of the basics of venture debt. We're going to have an advanced topic / round robin, and then we'll wrap it up with round 3 final thoughts where you'll hear from each of our panelists. Round 1 is the basics. We're going to kick off with the leader in venture debt for the last 3 decades, and a good lifelong friend and client, Katie Sobel from SVB. Take it away, Katie.
Hi, everyone. Great to be here. So yeah, to start off with the basics, what we're talking about today, venture debt. I think there's a lot of different flavors for venture debt, which you'll hear kind of throughout the panel today. But the most basic definition that we think about is it's a term loan made to venture-backed companies with an equity component, typically a warrant. You're going to hear different terms for different stages, but there's typically interest-only period followed by some kind of amortization. They're typically very flexible loans given kind of the stage the companies are at. So either no covenant, covenant light. Given that the companies are burning cash still, we've got to have somewhat of a premium on pricing compared to maybe other types of loans in the market. With the cash pay and then also the warrant component. And then they're typically, you typically would raise venture debt alongside an equity raise. So I like to think of it as, what are the benefits to founders in raising venture debt? And I think the main benefit is that it's a cheaper, non-dilutive form of capital. It's super important in the early stage when valuations can vary greatly between your capital raises, between booking a large contract. And so it's a great tool, for our founders to use. I kind of like to think of it in 2 different ways where it either allows founders to raise slightly less equity. So maybe instead of raising $20 million in equity, you raise 15 and then raise 5 in venture debt alongside it. Or it kind of can be an insurance policy to give you extra time on the back end if it takes a little more time to get to that next milestone that could potentially increase your valuation. Along with being less dilutive from the financial perspective. You're not giving up a board seat or, any kind of control over the company. So it's, like I said, a really great tool for founders to use and to help companies, kind of in that early to growth stage.
That's great. Thank you, Katie. So that's kind of round one of the basics from what the product is. I think what a lot of you are going to be very interested to hear about are what are the benefits of investing in a venture debt fund for LPs. And Zach from ARI is going to take us away and explain some of the benefits of it for investors.
Sure. Thank you, Matt. So yeah, the big thing is really that we're in an environment where it's hard to find yield in fixed income, and the equity markets are very highly valued. So just for context, if you look at the S&P 500, it's trading at 45 times earnings right now, roughly. Historically, it's traded at 17 times over the last 100 years. And over the last decade, it's been about 21 or 22 times. So if you think about it, the S&P could fall 25% tomorrow. We could have a Black Friday type event from 1987 where the stock market crashed, and it would still be trading at 2 times its historical norms, right? So that's the public market. Then if you look at venture equity, pre-money valuation for both early stage and late stage VC has gone up 50 to 150% year over year, right? So to put it in context, the S&P multiples expanded about 65% year over year, and venture capital valuations are 50 to 150%. Excuse me, 50 to 150%. So you've got these crazy equity market valuations, and then to top it off, we've got specific examples that are what I would call borderline insane, like meme stocks. AMC Entertainment is a great example, a movie theater chain that is trading recently at 8 times its pre-pandemic highs when nobody's going to the movies, right? And that's because of what was going on with retail investors and really had no basis in fundamentals, right? In addition to that, you've got recently, I think it was last week, there's a company called MicroStrategy that issued $500 million in junk debt. I don't normally call it junk debt, but in this case, it really is junk debt. $500 million to buy Bitcoin. So they borrowed at about 6.25%, and they're literally just going out and buying Bitcoin with it. No strategy around it, no structure. Just we're borrowing $500 million to go buy Bitcoin. So I think the market's insane right now on the equity side. Personally, I think people are buying assets that they don't understand. I could make the case that cryptocurrencies fall into that bucket as well. So there's a lot of speculation, and people aren't really looking at intrinsic value anymore, meaning the cash flows that these assets produce. They're just basically saying I could sell it to the next greater fool, right? So that's kind of some context. And on the fixed income side, clearly we've got government yields close to zero across the entire globe. The high yield index is trading at 4%. The Barclays Ag, which is kind of the key index for the public bond markets, has lost 3% year to date. And there's massive risk building up because as rates rise, fixed income prices fall, right? So you basically got no yield and you've got a lot of downside. So that's just context. So this is prelude to why venture debt is so attractive in this market. To Katie's point, everything that she said makes a lot of sense. Borrowers are looking for this product. They need it to grow. It's cheaper than equity. It's faster to obtain. It's certainly a lot less dilutive, right? So there's a real demand, a fundamental demand for this product, right? So that's underpinning everything. When you look at where the yields trade, it depends if it's coming from a bank or a fund, but on the fund side, which is where I focus, the yields that we're seeing in the market are typically double-digit cash yields, and you're also getting an underwriting fee, a back-end fee, and you're getting equity warrants. So total return historically in the asset class has been north of 20%, and most of that's contractual income. So think of it as about 15% cash annually on the debt side and about 5% annualized from the equity warrants once they're monetized. This market, things are a little bit compressed, but you're still looking at IRRs in the 15 to 20% range. I mean, I've got a stack of deals as high as my desk that I could print right now, 15% all in. And they're very low risk. So if you look at the historical losses, and Katie can speak about this for SVB, they're very low. Some of the better venture lenders have loss rates less than 25 basis points through multiple market cycles. SVB is in that context as well. So you're basically talking about 15 to 20% returns with loss rates comparable to investment grade credit. So if that doesn't get you excited, like I got some swampland in Florida to sell you, right? I mean, that's the basis of why investors are flocking to this, because they can't get yields like that anywhere else, and it's got the best risk-adjusted returns of all alternative assets. So that includes private equity, venture equity, real estate, real assets. I mean, it's been a phenomenal asset class for years, and nothing has fundamentally changed in the sense that it still provides very high risk-adjusted returns. And in addition to the returns, it's also a great portfolio diversifier. Typically, you're the only debt in the capital structure. It's not really tied closely to the macro markets. So if the S&P falls 50% tomorrow, is it going to affect the value of these investments? Not really. And we saw that play out during the pandemic in Q1 of last year. The stock prices of companies that traffic in venture debt got hammered, but the underlying value never changed. They wound up doing quite well over the course of the pandemic. So I would say that the biggest factors that investors really are looking for are the risk-adjusted returns, the great diversification, but also capital protection. I don't know if Katie mentioned this specifically, but the majority of these loans are senior secured with first lien assets. So you've got a blanket lien on all assets, and typically you're building in really thick margins of safety when it comes to asset coverage, specifically around cash. So most of these companies have already raised a bunch of cash over 5 to 10 years. They've just done an equity round, and you're typically lending 20 to 25% against the cash they just raised. So think about that in LTV terms. It's a 20% or 25% LTV versus the cash they have, right? So this is why they don't lose money. So you've got this great downside protection. And then the last benefits that are worth mentioning, short duration. These are floating rate loans almost 100% of the time. So if you're worried about rising rates and you're worried about inflation, which I certainly am, you definitely want to be in a floating rate product. And this is the highest yielding floating rate product on the market. You've also got very limited J-curve effect that you wouldn't see in PE or VC. You're getting cash passed back to you as an investor through interest and fees right off the bat. And then lastly, if you're in a private fund structure, you have amazing co-investing opportunities. And I think that's actually where there's the biggest upside for investors that want to invest directly. So if you've got a lending platform, or if you don't have a lending platform, but you want to see the best deals in the market, well, you go partner with a private fund that specializes in venture debt. You're going to see deals that none of your peers are seeing. So I think I'll leave it at that. And if there's any questions, we can follow up on those later in the panel.
Yeah, that's great, Zach. That's really good. Well, hey, so I think that's it for round one on the basics. We're going to go round two, which is the advanced topics and the round robins. And the first topic in round two is going to be what are the various stages of venture debt? And Will is going to kick us off on the very early stage.
Yeah, thanks, Matt, for arranging this. So I help run about a $50 million economic development-backed early-stage venture debt fund on behalf of the state of Massachusetts. So we're typically transacting in the $1 to $2 million loan size, obviously senior secured, and we're backing companies all the way from pre-seed to Series A typically. Companies have raised typically $1 to $5 million in their most recent round of equity financing that we're leveraging. And we're typically providing 6 to 18 months of additional runway for that company to hit one or more financial or operational milestones prior to raising their next round of venture equity. So obviously hitting on all of the high points that Zach and Katie both mentioned, lower dilution, significantly greater runway, to enable higher valuations for both the insiders and current investors to recognize, higher valuations on their current stakes. So we're an industry agnostic fund. We do everything from medical device, diagnostics, digital health, obviously SaaS, which is a growing and huge portion of the venture debt market today. And then everything from robotics, advanced spinouts from the research universities, artificial intelligence, quantum computing, you name it, we've probably played in the industry here in the state of Massachusetts. And so obviously we're in the riskiest portion of the market. So our debt is some of the higher cost debt out there, but in fulfilling our mission of stimulating job growth and backing the innovation economy here in the state of Massachusetts, we've had exceptional returns. It's a fun place to do venture debt, and the market, as Zach and Katie said, is continuing to grow, and there are a lot of emerging managers out there who are beginning to exploit the space, but it really is a non-competitive industry for the most part. There's a handful of players. There's more deals than can be done, and it's an exciting time for really what is still an emerging asset class.
Yeah, that's great. Well, I totally agree. It is an exciting time. I've been doing this for a couple decades, and it's never been more exciting in this space. Okay, so next on the stages of venture debt, Katie from SVB is going to talk about classic SVB style venture debt. They invented it, so tell us all about it, Katie.
Sure. So SVB is a little different than, I guess, the other panelists on here, is we're a commercial bank. And so we do various different types of debt, from super early stage to later stage corporate finance type deals. But for the purpose of today's call, I'm just going to focus on our early stage or accelerator and growth portfolio venture debt product. And so this would typically be for sometimes pre-revenue, but usually a very early revenue stage, up to maybe like 25-ish million in revenue. The sizes for these term loans are usually about $2 to $8 million. Similar to what everyone's mentioned before, we do take a senior blanket lien on the companies we're investing in. This particular portfolio is funded by bank deposits, not a fund investment. And so the rates on these type of facilities are much lower. They're typically, well, not typically, but now given just the current rate environment, they're pretty low. So a cash interest rate on something like this right now is in kind of the mid to high 4s to 6% rate. And then there's always an equity component on it as well. And kind of starts out with Series A company. Very rarely are we doing seed, but sometimes. And then they have to have a venture capital investor involved as well. So we would do later stage debt as well. It's kind of similar to what Laura and Zach are talking about, but in those cases, we would be participating with a fund, so like an Oryx or an ARI or our own SVB Capital Fund.
Cool. Thank you, Katie. Okay. Laura, you ready to go?
Yeah,
Tell us
absolutely.
about the late stage of the venture debt market.
Yeah, for sure. So Oryx Growth Capital has been in the market for about 20 years, providing check sizes from 5 to 50 million with a sweet spot that's really 10 to 30. And where we have played has really changed over time. So it used to be that around 50% of our portfolio was first lien, where we would compete against an SVB or a bridge bank, and the other 50% of our portfolio is second lien. But with how aggressive SVB and bridge bank have been over the years, recognizing the opportunity within venture debt, we really have found that where we play for the most part these days is the second lien market. And the value that we bring to a company with a second lien facility is usually we're willing to provide debt beyond what SVB or bridge bank might. We also are willing to provide a fairly large delayed draw term loan so that they can use the capital over time as they grow into it. The vast majority of our clients are growing well over 20% per year. So, while they may not need the capital today, certainly within 12 months they may. And so in that way, we often partner with, Katie and other folks in, the first lien part of the market. Given that we're taking a second lien, obviously our rates that we charge are a little bit higher. The IRR on our blended portfolio is in, let's call it the 12 to 15% range, and we have deals that are well over that. And then other areas where we compete more heavily with the banks, and so we might be charging only in the 8 to 9% range with a kicker to get us somewhere around 10. And so, we look at a large range of deals, and so within the software industry, which is the most heavily trafficked and competitive part of venture debt because it is the most stable, we're seeing those lower end of the rates. And then when we look at fintech deals or consumer deals where there isn't as much recurring revenue, there isn't that sort of guaranteed, 5x exit valuation, that's where we might charge a little bit more and provide a little bit less leverage. And so our selling point relative to an SVB is typically that we're going to allow them to have the capital for longer. It's going to be more flexible. There might be more undrawn, and we probably won't have as many covenants, and we're also not holding their cash. So, a little bit more like a mezzanine loan, but we do always take a blanket second lien on all their assets.
Awesome. Thank you, Laura. All right, Zach's going to round out this question with the middle to the top of the market.
Sure. So there were some really good points brought up. I just want to touch on a couple of things. Will had mentioned that there's plenty of deals to go around, and this is worth noting because I always get asked by LPs, how do you source deals, as if that's hard. And it's a fair question, but it shows that they're not really aware of what's going on in the venture debt market. There's so many deals to be done. The typical venture debt lender does about 2% of the deals they see on the fund side, the good ones at least. You see, I see hundreds of deals. I mean, it's basically just almost unlimited, and there's so many folks coming to market that have great ideas that are going to disrupt the current market, and all they need is capital, right? I mean, they've got ideas, they've got execution capabilities, they need capital, and historically, and even now, outside of SVB and a few other banks are not built to provide loans to these types of companies, because banks are, I used to be a banker. I was, I did leverage loans during the financial crisis and we managed a $6 billion TMT portfolio at Scotiabank, right? So I know all about leverage loans and all about banking. I can tell you what they look at. They look at your historical track record, they look at your hard assets, and they look at your EBITDA and cash flow, right? And here's the problem for banks when it comes to venture lending. These companies don't have a long track record because they're startups, right? They're relatively early stage. They don't have positive EBITDA almost ever. That's not a negative thing. It's because they're growing at 50 to 200% year over year in most cases, right? So they're spending all their money to grow so they can take over the world, right? And so traditional lenders, though, can't get their head around it. They say, oh, so you don't have 5 years of historical financials. This is the first time you've done this. You've got negative EBITDA and you don't have property, plant, and equipment that we can get a lien on. It's like, yeah, that's the case, but that's why you get paid 15 to 20% to do this as a fund manager, right? And there are ways that this is de-risked, though. Again, I won't get too much into this, but it's really about sizing the loan right, investing in companies that have already been venture backed, that have 5 to 10 years of going through due diligence processes with the best VCs on the planet, right? These are companies that are already on their way to success, great success, and what they're trying to do is minimize the equity they have to sell to get over the finish line, right? So there's a real fit here that most folks haven't stepped into. So I just wanted to make it clear that there's ample deals. And when it comes to folks that invest in the space, there's actually very limited ability to get in if you're an LP, because you can invest, you could buy SVB stock, but that's not a pure play on venture debt, right? And you can't get into Will's fund because it's a quasi-governmental fund. Oryx has never had a fund that you could get into. So, and I'll give you one quick example. I was down speaking at the TechSpurs conference, which is the largest pension conference in the country, or certainly year to date. It was 500 people in Austin a couple weeks ago. And I was talking to one of the CIOs from one of the largest pensions in the state, and I was telling him about venture debt. He said, "Oh, we know about venture debt. We've been invested in one of the top venture debt firms since 1996, and they've kicked off 25% plus like every year for the last 25 years. And they're raising another fund this year. I won't mention the firm, but if you want to know, ping me offline." And I said, "How much capacity can you get in their firm?" Because he told me, "I'm begging them for capacity. 25 million bucks is how much they're getting, right?" This has happened 2 weeks ago. So if you're an LP and you want to get in, it's hard to do, all right? And I mention this because we're in the process of raising a large fund right now, which will hopefully be one of the largest venture debt funds in the country at final close. And folks are very interested, but I don't think they realize that if they don't get in now, they're not going to get in. There's just no way in. Most of these funds are 10 times oversubscribed if they're any good. So with that said, in terms of what our fund does, we're probably closest to Oryx in terms of the range of size we do. So we'll do as small as 3 million, as large as 50. If we want to go over 50, we can do that because we've got deep-pocketed co-investors. Typically, what we're looking at Series A through Series D companies with revenue of 5 million to 100 million. In terms of sectors, it's really it's fintech is our core expertise, and we all come from banks and the top asset managers, so we know fintech better than pretty much anybody. We're also very big in software, of course. Who isn't, right? Anything that's tech enabled, where we understand the business fundamentally and where we can structure the deal so that it's low risk, we will look at. So at this point, that's basically every sector, although we're not big in biotech just because we don't have deep expertise there. And lastly, I'll mention that we invest in both the US and Canada. Canada's got a thriving startup scene, very good in AI. So we definitely are open to that. And what differentiates us, and I think what differentiates some of the private funds versus the banks, is we're much more flexible and we're much faster. We don't need to go through 3 committees to get the interest only period extended, right? We can do that in 15 minutes if it makes sense economically, right? And so we look to structure deals that are that fit the needs specifically of the founding team, and that includes interest only periods, the amortization schedule, the maturity length, the cash pay versus sometimes PIK interest. Sometimes there's a component PIK, back end fees, the sizing of the warrants. All this stuff can be structured. So we think of it as we're folks who have executed probably, I don't know, collectively as a team 100 billion in debt transactions. I've executed over 50 billion myself. So anything that we're seeing, we've seen before and can structure, and that's really how we differentiate.
Great. Well, look, that's a really good lead into the next question, and really kind of my best expertise, which is how do lenders in the venture space work with each other? As everyone sort of echoed, the market right now, there literally are so many deals. Each lender tends to specialize in doing the deals that are right for them. The thing that Zach alluded to is SVB kind of invented this product and has frankly dominated the market for doing venture debt by building a bank to do something that other banks didn't want to and couldn't do. And so they sort of have cemented themselves by being able to flex up and down the whole range of products in the market. You're also seeing, interestingly enough, funds at different levels in the space where even just on this call, you've got funds who invest at different stages and are much more bespoke. And so the market has really differentiated itself, where you've got SVB as kind of the clear leader on the bank side, with others competing around it over the years, in and out over the years, acquisitions over the years. On the fund side, the funds have just proliferated, right? It's been a straight climb to the top. There's way more debt funds now than there ever were because the market is bigger than it ever was. And so how do all these lenders work together? As someone who works with many of the banks in the space over my career, many of the debt funds in the space, people ask me, how do you represent all these people who compete with each other? And I think the real answer is, if you really think about it, they really don't compete. They might compete on an individual deal, but they are like fishermen in an enormously stocked pond, just every time you cascading a bite and going, yeah, I don't like that one. I don't like that one. Oh, that one's perfect. So Laura is going to talk to us about how the market functions, the ecosystem, how banks, funds co-lend together, refer business, et cetera.
Yeah, sure. So, we get our deal flow from three primary sources. So venture capitalists, which you would expect, and then banks, and then direct calling, right? And we only have, let's call it 15 people on our team. So somebody like SVB who has, an army of bankers out there calling on startups every day is really going to have the best pipeline. And so where we see a lot of our deal flow is from the SVBs and the bridge banks of the world. And so whether it's that it's not a fit for them and then they pass it on to us, or perhaps they are not willing to go as deep into the capital structure as the founder would like, we get a lot of our deal flow from those folks. And then we also partner with other folks that are, a similar fund size to ourselves. So, Hercules and Triple Point are some of the biggest names in the industry that we compete with and also partner with. So there's times at which, a company is sort of no longer a startup, but what we call a growth stage company with $50 to $100 million in ARR. And at that point, perhaps they want a small revolver or a working capital line from a bank, but then they really want a flexible line to go out and acquire other companies, or they have, big lofty growth projections over the next few years, and they really want, a large facility behind them to support that growth. And in those instances, we'll partner with all kinds of middle market lenders out there to make sure that we can provide the most flexible capital to the companies that we serve. And even on the smaller end of the range, so I'm talking to William later this week because he has a lot of companies that are now kind of graduating from that really early stage frontier life cycle that they're in, and they're looking for more debt, and perhaps they're not going to be a great fit for an SVB or a bridge bank for various reasons. And so he might call me and pass on those deals. And then I come across companies all the time through direct calling, conferences, and other means where I meet companies, and sometimes they're too small for me, and I pass them on to other lenders that are really looking for that early stage company as their target market. And so it really is an ecosystem, and all the players know one another. And so the vast majority of our deals come from that ecosystem, and it's not just a lone wolf out there hunting for direct deals all day long.
Matt, can I just chime in real quick?
Nope. Yes, of course.
Yeah. No, I get asked all the time, how do you compete with SVB? And to Lara's point, we don't compete with SVB, right? We partner with them, and quite frankly, we don't really compete. Also, to Lara's point, with the majority of the market, it's kind of like, I played as a basketball player growing up, and you would have rivals. So in a certain game, you might be playing a rival, but then when the game's over, you're friends, right? And that's kind of what this ecosystem is like. Everybody knows that there's enough pie for us all to eat as much as we want. I can have 3 slices of pie, and so can Will and Laura and Katie and Matt. You get a piece of all of our pies as one of the preeminent lawyers in the space, right? So it's worth noting too that I get called all the time by founders who are looking for capital, debt capital, and I refer them to SVB and some of the other commercial banks 95% of the time, because my first question is, have you talked to the banks? Have you talked to my friends at SVB? Because guess what? They're going to have a much lower cost of capital, right? So go to them first, and come back to me later, and we can either do something in conjunction with them, or if they pass on you for various reasons, then maybe we could still get something done, right? So I just want to make that clear. There's not competition between the funds and the banks. Like SVB is underwriting loans at like 4.5%. Like that's not economic for a fund to do, right? So we never spend 1 second of our time or effort on competition. It's all about collaboration. And I came out of the syndicated loan market, which 25 years ago didn't really exist, and then it became huge, and now the leveraged loan market's one of the biggest markets in the world. Well, guess what? That really hasn't come to venture debt right now, but that's where we're headed, right? So this is not a zero-sum game. This is much more a game of let's figure out how to collaborate, how to find deals that fit others if they don't fit us, share risk. Like that's why the syndicated loan market came about. It's risk syndication means you're reducing your risk, but you're sharing in the upside, right? same thing that we do here. And Oryx has done this very well. We do this, Will does this. So I just want to make that point, is that it's really about collaboration in this segment of the market, and people that aren't in the market maybe don't get that, but that's the way it is.
That's actually a really great lead into our next point, which is how does the collaboration between the venture capital investors or other sponsors and the venture debt providers work? And Katie is going to talk about the timeline of raising equity and raising venture debt.
Yeah. So as kind of, I think we alluded to this before, but typically when you're looking at raising venture debt, it's alongside your equity round. And that can be pretty counterintuitive to founders initially when they're looking at that, because they're like, I'm flush with cash, why would I get debt now? And I think the biggest reason is it's much easier to raise debt when you are liquid, right? Our typical cycles for companies at this stage are you kind of raise you raise equity, so you're flush with cash, and then you're going down and burning through that cash until the next equity raise. And so definitely in the early stage, when you're looking at your when the lenders are looking at our source of repayment, it's going to be the company's ability to raise another round of equity. And then as you get further along, it might be the company doing an IPO or getting acquired or something like that. And so how I like to look at it and talk to founders about it is say, you're absolutely right. You don't need this cash right now because you just raised equity. Where it's valuable is kind of on the back end. So if you think about it, it's almost like a pre-negotiated bridge loan, for example, where you can draw on that the funds. Typically, there's some kind of draw period negotiated up front. You could draw on the funds later when you feel like you need it. Sometimes the draws are kind of required, sometimes they're not. You definitely have to pay for that ability to have that capital available to you regardless. And then that might allow you to wait, 3 more months or 5 more months, depending on what your cash burn is, to go out and raise the next round or close a transaction. And in terms of valuation, that can be astronomical in terms of the savings on dilution or value, sale price or anything along those lines. So it is really helpful to think about raising that venture debt right when you're looking at a round. We talk to people who are currently fundraising and kind of try to put something together alongside the close, but typically pretty quickly thereafter, you would want to put that debt in place.
Katie, can you talk a little bit or maybe we all can talk about some of the metrics that we look at? Because I get asked all the time by founders.
Yeah. And by the way, that's my last question there for each of you, is how does your firm screen, structure, and size deals? You want to go small to big and start with Will?
Yeah.
Well, how do you guys structure, screen, and size deals?
Yeah, I think for us on the early stage, one, we're going both top down and then bottoms up, right? So we have to love the industry and then the sector that the company is playing in, right? And they really need to be differentiated in their approach to solving the problem that they were formed to solve. So that's number one. Number two, you're looking at the quality of the management team. Typically at our stage, it's really 1 to 3 people who are really driving the bus, right, and creating the value that the equity investors have seen initially. The third thing that we typically look at, what's the company's fundraising history, right? Most of our companies have raised friends and family round, a pre-seed round that's typically led by an angel group, and then maybe they've got an early stage seed venture capital fund and one or more family offices. And building the relationships and the network with those investors gives us comfort as well. And then more on the bottoms up approach, how much cash is the company burning, right? And how much runway does the company have currently on its balance sheet, or will it have once it closes the equity round that they're currently raising. And for us, you know, what needs to be made clear to the company is we are not a substitute for equity, right? We are merely a runway extender to allow that company to once again hit one or more financial or operational milestones prior to raising their next round of equity financing. So, you know, we're not a substitute, we're a complement. And then, you know, fourth, you know, how has the company performed on its historical milestones that it's communicated to investors in the past, right? You don't want to back a company that has a track record of consistently failing to hit, you know, its operational and financial milestones. And so really those kind of 5 things are the top of the funnel. And then obviously you're going through a very similar due diligence process, just like an equity investor would, right? But it just so happens that the investment tool that you're using is secured debt with an equity kicker as opposed to, you know, pure equity exposure. So that's generally how we look at our process. But every situation is unique, and that's what makes this sector of the market so fun, you know, venture debt overall.
Awesome. Thank you, Will. Hey, Katie, I know you've already sort of alluded to this, but you know, if we just ask the question straight up about SVB, how do you source, structure, size your deals? What's the model?
So we are focused primarily on technology. And so any, you know, obviously we want the companies to have some sort of IP. And I would say the only real exception to that rule is our consumer portfolio. So a lot of times there's not much deep tech there, but if there's a consumer company we're looking at, it's because they also have a technology-based venture capitalist that's invested in them. We also have kind of separate groups that cover our life science portfolio. So we do a lot of med device and biopharma as well. And then we have a specialty fintech group, and we also have an energy resource and innovation group. So we kind of cross the gamut of tech companies in the space. And then we look at it fairly similarly to Will. I mean, we're looking at the company's financials and forecasts. We want to make sure the companies are growing at an appropriate rate for the sector, which, you know, would be a lot higher for a SaaS company than maybe hardware or some other sector, but making sure it's kind of appropriate growth rates for what we would expect to see kind of on the early stage. We're a relationship bank, so if we've had a prior relationship with either the founders or investors, that's really important to us. We're looking at typical financial metrics for SaaS companies, so KPIs, gross margins. And then in terms of size, and this is speaking more towards the 2 to 8 million kind of earlier stage venture debt, we're typically looking at like 20 to 30% of the equity raised at that time. Obviously, there's a lot of different factors that will play in, and we can also get a little creative on the structures with kind of tranching or milestone-based access to additional capital in order to get to those higher numbers if that's what companies are looking for. But like Zach talked about earlier, I mean, we are one of very few banks in the market that is lending money to companies that are losing money. And we've done this for almost 40 years now. And so we're very used to kind of going through these cycles with our companies. We call ourselves very patient lenders, but we are, you know, still a regulated bank. And so have to deal with all the kind of hurdles that come with that as well.
Having been your outside counsel for nearly 2 decades and been through 2001, 2009, everything that's happened since then, I can confirm that SVB is a very, very patient lender. They definitely take, I wish my parenting were as patient as their banking. So let's leave it at that. Okay, I'm gonna give it up to Laura to talk about how they structure, size, and screen their deals.
Yeah, so on sourcing, I think I hit on, you know, it's intermediaries, it's venture capitalists, lenders are one of our best channels for getting in deals, and then quite a bit of direct calling. And so when we look at a deal to determine whether or not, we want to move forward, we're looking at all the key metrics that everyone mentioned. Given that we're a fund and we are going into a higher levered situation, we are really focused on enterprise value. So we call ourselves an enterprise value lender. So while, SVB might really care about how much cash they have in the bank or how much AR they have, especially for the revolver component, we are really doing the same underwriting that an equity firm would do. So we're going to look at the TAM, we're going to look at the growth rate, we're going to look at the industry. I focus on fintech. I do everything across the board, but really focus heavily on fintech. So I know that market inside and out, and figuring out whether or not we believe this is a winner in the market or not. The other thing that everyone mentioned is we are lending money to companies that are burning money. And so everyone always asks me, like, how do you do analysis on that, right? Because there's no EBITDA. And what we want to understand is really the unit economics and the KPIs. So I always say this to my analysts as I'm understanding explaining unit economics, is I want to see that if I put 1 coin into the business, I'm going to get 2 coins out. So I want to make sure that that burn is really customer acquisition or building a product, and not just because I fundamentally have a money losing machine here in front of me. And the way that we do that is we do, the CAC to LTV and the rule of 40 and all of those great SaaS metrics that, folks use in the industry. And then after that, it really is figuring out what we believe the company's strengths and weaknesses are, and then structuring around that. So, for the really high flyers, and I know it's the leader in the market and their unit economics are singing, like, I know that it's going to be a competitive deal. And so I'm going to structure it to win, because I believe that the risk is fundamentally very low. And that even if there is, a hiccup, that ultimately there is enterprise value and IP to support my loan. And if I think, it maybe is a little bit riskier of a loan, then that's where I see the opportunity to increase my IRR and perhaps put some covenants on the deal to make sure we have tripwires in the event that, things do go sideways. And so really, the robust underwriting process and screening process that we have is what we use to then determine how we're going to structure a deal. And then, in terms of structure, so we usually are around 5 years in term, anywhere from 12 to 36 months of IO. We've just started doing bullets as well, which are now more common in the industry for those, really strong credits. I may have a pricing grid in there so that the company can, benefit from the reduction in risk that I have as they grow into the loan that I've provided. And we usually do have some sort of warrant or kicker in the, most competitive situations. Sometimes we might just do a final fee because that's something that will help us win the deal. So it really is determined on that credit underwriting that we really focus on.
Fantastic. And to close out the thoughts on structure, size, screening, Zach, you gave us some great thoughts before, but tell us what else don't we know about, a super fun deal?
I think Katie, Laura, and Will covered a lot of the key points, so that was really helpful. So I'll try not to duplicate a lot of what they said. One thing I want to point out is that the venture debt market is what's called inefficient, which is a very good thing, meaning it's fragmented and there's information asymmetries among other inefficiencies. So we don't compete for deals that we consider overbanked or hyper competitive, because for every deal in San Francisco that's got 15 term sheets, there's one in Salt Lake City or Nashville or Denver, Chicago that's got 0 or 1. So one of the things we've been seeing in the market a lot is some covenant light loans, right? We don't do that. We believe there should be covenants. It doesn't constrict the borrower, but we like to see covenants around either liquidity of some sort, like cash, some sort of cash metric, or performance to plan is one that we like quite a bit. So if they miss performance numbers by a certain amount, that would get us back to the table to speak with them to figure out how to help them, right? And the way I think about it is the earlier we can help companies, right? And the earlier we can figure out what problems they're having, the less risk we have and the more collaborative we can be with the borrower. So I always think of it as we want to have some covenants in place and we want to monitor our investments very closely, because A, we don't want to lose money, and that's rule number 1. And rule number 2 is always follow rule number 1. But B, it really helps us form long-term partnerships with the borrowers when they know that we're not there to just take as soon as things go off the track a little bit. We're here to help them identify how to fix the problems and collaborate with them. So that's something I just wanted to emphasize, is the covenant aspect, and also the long-term partnership aspect. Our goal is to fund these companies essentially in perpetuity, right, until they go public. Because why not? Because once we know the company and they keep executing on what they say they're going to do, we want to keep lending to them, right? So we want to lend to a company Series A, and we want to be funding them all the way through IPO. And so that's one of the benefits of partnering with us, is that we are actively looking for those types of partnerships. We want to grow with the company, and that's that's a huge competitive advantage, because most companies or most funds can't do that for various reasons. Oftentimes they just don't have enough capital, quite frankly, or enough dry powder, or they haven't planned appropriately because they're not good portfolio managers. So in terms of sizing, everybody talked about what we look at. So Laura mentioned enterprise value. Other folks in the space sometimes use the term revenue-based financing. They're not exactly the same thing, but they're similar in the sense that we're not looking at EBITDA and free cash flow. We're looking at EV, and we're looking at we're looking also at annual recurring revenue, right? Is typically ARR is what folks will look at. So in terms of putting a size component around that, which I don't think anyone's done, everyone's different, and the market's a little bit hot right now. So some people are doing some really stupid things, quite frankly. But if you look at what's worked in the past that has led to these loss rates that are sub 25 basis points annualized, it's really lending typically 10 to 15% of enterprise value. So you've got a massive cushion right there. So even if the company dropped 80% in value, you're still covered. In terms of looking at what they've raised in the last equity round, oftentimes debt will either come in, debt comes in typically after that equity round, 3 to 6 months after, sometimes in conjunction, but most often after. And typically that's been sized around 20 to 25% of the last round. So if they just did a $40 million round, the term loan would typically be like $10 million, right? Again, people might do bigger, right? But that's what's worked in the past if you don't want to lose money. And then the other thing to look at is the loan size relative to the ARR, to that recurring revenue. And that's expanded a bit in this market, but typically that's been less than 50% of annual recurring revenue, although some lenders in the market will go 75 or 100% now. I tend to think that based on all the data we've seen, and we've seen it all, we've done a lot of historical analysis on this, typically less than 75% of ARR is where you want to be sized. So the way we think about it, and I'll wrap this up quickly, is like everyone else has said, start with top down. Do you like the management? Do you like the industry? Do you like the management team and believe they can execute on their strategy? Does the product fit the market, right? Do they have customers that are established? Do they have revenue? Do they have a relevant competitive advantage and barriers to entry? Do they have a viable capital structure? What does their cap table look like on the equity side? That's actually very important, because if they've sold too much equity early on, a lot of the VCs aren't going to come in later because there's just not enough skin, there's not enough meat on the bone, right? So really understanding, is this capital structure viable over the long term? Are we going to be able to take this the distance? Do they have enough equity left to do that? Their path to free cash flow, and looking at their projections and seeing if they're achievable and realistic, and really on the deal side, structuring so there's really thick margins of safety. So what does that mean? So that's a Seth Klarman term from Baupost Capital. Do they have enough asset coverage, whether it's cash or intellectual property or some liquidation value? Do they have the VC sponsor support? I think that's very important, because typically that's the last line of defense. If things start to go awry, it's not all on the lender to make things better, right? In fact, part of the reason why this is such an amazing strategy is you've got these really smart VCs that have been working with this company and dumped a ton of money into it, a lot more than the lender has, and they've got a lot more at stake, quite frankly. Because if things go wrong, don't forget, I've got the keys to the car, like the keys to the house, so to speak. The lender has that control. So typically the equity folks are very interested in working constructively with the lender. And so just making sure that you're working with a good VC group and they haven't been jerks in the past and they want to keep a long-term relationship is typically a great way to de-risk this. But other than that, I'd say we're very similar to what everyone else has said. I mean, everyone's got the same kind of big picture views, and then it's just a question of like the nuances of how they underwrite and how flexible they are and things like that.
Hey, we've got 5 minutes left. We were going to do a final round of thoughts, but maybe I'll just give each panelist 60 seconds to wrap up if they want to talk about the topic we had talked about. Fine. Otherwise, quick 60 seconds to wrap up final thoughts. I'll go to Will first.
Yeah, 60 seconds. So in setting up companies for their first venture debt is where we come in. Our companies are very early stage, so we take a real consulting approach with our companies. So we're setting them up for success, getting them their first CFO, either a part-time strategic or a full-time CFO, getting them to a stage where their financials are fully audited, which is a requirement for later stage VCs or later stage debt providers, building out their reporting functions, monthly, quarterly reports that we require, and then helping them identify the proper service providers to really get them to that next stage of growth, right? From, sub $1 million of revenue to 5 to 10, where Zach, Laura, and Katie can really help them out with a much larger venture debt piece. So not only are we providing debt, but we're also setting these companies up for success later on in their life cycle.
Great. Katie, final thoughts?
Sure. Yeah. So I guess I just want to, make it clear that SUV is trying to work with startup companies from very early garage days in terms of providing a banking relationship up to our corporate finance group, which does kind of large multi-$100 million syndicated deals. And then, everything along the way that we kind of talked about today and partnering with the other venture debt funds. We also have our own venture debt fund, which I think I mentioned earlier, SVB Capital. I do want to give them a quick plug because in Q3, we'll be raising what I believe is our largest fund to date. I think it's going to be announced in the next week, kind of details around that. But if anyone is interested, they can feel free to ping me and I will put you in touch with our investor relations team.
Great. It's super exciting, Katie, that's going on. So, okay, Laura, you want to close out? 60 seconds.
Sure, absolutely. So, Oryx Growth Capital, I think I'll just talk about the way we differentiate in the market and just sort of where we play. So we have a single source of capital, which is a large Japanese conglomerate, meaning that we have evergreen balance sheet capital. So we have no fund life. We have no time at which we need to return our funds. We don't have any banking regulation on our funds. And so what that means for founders and for partners of Oryx is that we are not in the game of, churning our clients or increasing fees every time something happens. We're really winning if we hold that loan on our balance sheet, for as long as possible. And so we're really focused on client retention and relationships. So we have clients that we start off at the Series B range and then go all the way with them until they have a liquidity event. So either that's an M&A transaction or IPO. We like to keep clients, so we make it easy. We don't try to refinance every 2 or 3 years. We, keep the same loan in place and perhaps just do a small fee to keep you in there. The other thing that's nice about our balance sheet is that we have, $400 billion in assets under management. So while we do 5 to 50 off of our own balance sheet, we have partners that can go well above that. And so we're able to grow clients over time. And I think that's just a really important differentiating factor for Oryx relative to some other players in the market.
Awesome. Zach, 60 seconds.
Got it.
Go.
So what we're really providing here is access to innovation as an asset class, right? In my opinion, innovation is now an asset class. And you can either play it from the equity side where valuations are crazy, or you can play it from the debt side where you can earn 15 to 20% and be a senior secured lender and have a good portfolio diversification tool as well. So that's kind of what I want to leave LPs with. If you're looking for a smart investment in a crazy market and you want to be involved in innovative companies, but you don't want to buy in at crazy valuations on the equity side and wait 12 years to monetize your investment, then you should be looking at venture debt. We're raising $500 million right now. We've got some of the biggest institutions and family offices in the world that are very interested in partnering with us long term. So to Laura's point, basically infinite balance sheet because they all want to be co-investors. So if you're interested in that, you can email me at zellison@arivc.com. And then the last thing I'll mention that we didn't talk about is what we're trying to do is create access to capital for all different types of founders. So there's a lot of women and minorities that typically have not had access to capital. Roughly 5% of all capital in the venture ecosystem goes to women and minorities, despite the fact that 70% of the US population is women and minorities. So we view this as a huge opportunity for us and our investors to do well, to do really well economically, but also do good and create access where historically there hasn't been any. So that's one of our huge initiatives that I'm happy to talk about with people offline.
Yeah, that's awesome, Zach. I mean, access to people who traditionally didn't have access to these sources is a win for everybody in the market. So thank you all for taking the time. I mean, we finished right on time. Hopefully this was informative. Hopefully people got some good insight on the market. As Zach mentioned, I'm happy to chat about any questions people might have about history of the venture debt market, what typical deal terms look like. You know, I've been representing lenders in this space for almost 2 decades and have seen almost every conceivable deal structure, and happy to lend that expertise if anybody is interested. And then I don't know, Zach, does Mitch want to say something on the way out?
Yeah, and Mitch, why don't you take us to the exit? And Matt, thank you for moderating this panel and for DLA Piper support.
Yeah, our pleasure. We're glad to be involved.
Fantastic. Well, first of all, I want to thank again Matt and DLA Piper for sponsoring today's program. Thank you very much for making this possible. Zach for bringing together a dream team of panelists to sort of explain this area that I think people need to know about, especially allocators. And I, of course, want to thank Katie, Will, and Laura for all of your insights today. So thank you, everyone, for joining us. And HFA will circulate a recording, and we will include contact data for our panel if you want to get in touch directly. And have a great rest of your day.
Thanks, everybody.
Thanks so
Thank you.
much.
Thank
Appreciate
you.
it.